Well, let's get started. On behalf of the Sandbox Centre, welcome to our Experts in Residence Financial Growth session featuring today's expert, the CFO Centre. For those who haven't been acquainted with me or the Sandbox, my name is Mackenzie. I'm one of the 6 team members of the Sandbox. We're located downtown Barrie and online to connect people and their ideas to business resources so that they can create a better life through business. And Sandbox is proud to acknowledge that we're positioned on the traditional territory of the Anishinaabe people, which include the Odawa, Ojibwe, and Potawatomi nations, collectively known as the Three Fires Confederacy. We also acknowledge the Wendat Nation, who occupied these lands prior to the middle of the 17th century. We're committed to educating ourselves and our community on the importance of honoring the first occupancy of this land while supporting with actionable steps towards reconciliation. Now, if you haven't attended one of our EIR sessions before, we're happy to have you with us. And for those returning, welcome back. So nice to see you all. Across a wide variety of topics and expertise, our EIR program provides a free all-access opportunity for you to share and receive expert feedback in order to support your business moving forward with greater clarity. Now, cash flow, today's topic. It's a vital part of the survival for every business, but there are definitely a lot of facets that can leave you scratching your head. Does this sound like something you can relate to? Well, glad you're here because our experts from CFO Centre are here to help you receive a better understanding when it comes to techniques for better cash flow management. In a brief moment, you'll hear from Jeff Bond, York Simcoe Regional Director. Jeff brings more than 20 years of diverse executive, financial, and operations experience acquired in the public, financial services, healthcare, and environmental services and e-commerce sectors. Jeff is a CFA with strong operational business expertise, having worked in both entrepreneurial and corporate environments, including 3 startups. Accompanying Jeff is David Ascott, principal, who is also an accomplished CFO with 25+ years of experience providing strategic and financial leadership of public and private companies in manufacturing, distribution, and agriculture. We're so excited to have the both of you here. Before we dig right in, we'd like to thank our community partners with sharing of our events, and a huge thank you to our sponsor, CFO Centre, for delivering today's session. If you have any questions that pop across your mind during the session, we encourage you to use the Q&A feature that's just at the bottom of the screen or the chat, whatever's good for you. We'll be sure to answer them along as we go. So if the gentlemen are on a topic and you really want to dig into it more or have any questions, feel free to put it in the chat and we'd love to get them answered. So without further ado and taking too much more time, let's get into the goods. I'd love to welcome Jeff and David. Thank you so much for being here today. We're super excited to have you.
Thanks very much, Mackenzie. As Mackenzie indicated, I'm Jeff Bond. I'm Regional Director for York Simcoe, but also a part-time CFO with 3 clients here in the Barrie area. With that, you've already heard some of my background. I'm going to turn it over to David, who's going to walk us through the presentation. We'd like this to be very interactive and encourage people to ask questions along the way. And I'm happy to introduce my colleague. David, over to you.
Thank you very much for the introduction, and good morning to everybody that's on the call today. As previously mentioned, we are talking about cash flow and tips for management projection and long-term progress. I've been a CFO for 25 years, working for various companies, from companies with billion-dollar revenue to pre-revenue startup. And through my entire career, what I've witnessed is that the importance of cash flow is there at every level. It just, depending on the size of the company, the materiality of the cash flow varies, but it is an important part of business. I worked for 8 years in Western Canada and for a very large, or Canada's largest agriculture equipment dealership. And the founder, director of that company had a saying, "It's never about the money until it's about the money, then it's always about the money." And for the first few years I worked with them, I just thought it was a bit of a confusing riddle. But after working 8 years in the agriculture sector and all of the different cycles of the feast and famine nature of the output and people who supply that industry, realized that the importance of cash flow was really the genesis of his saying. And I think it boils down to the fact that when issues are percolating up through a business, and you can see stress on the business, it's most likely the reason for that is cash flow struggles. So going into the agenda for today, we're going to talk about the importance of cash flow. We're going to have discussions around the understanding of the timing and the risks. And then we're also going to talk about different measures and strategies around cash flow. And as Jeff had mentioned, we anticipate that this is going to be sort of an open forum, and we'll take questions along the way. So very quickly, free cash flow is the movement of money in and out of a business. And I think anyone who's involved in business has spent a lot of time analyzing their P&L and the resulting cash flows of the business. But the statement also notes that it's including changes in working capital and investment in capital expenditures. So not only do you have to pay attention to the inputs and outputs of what's flowing through your P&L, but you can have, and I'll refer to it as money trapped on your balance sheet. You can have cash in inventory, you can have cash in receivables, or unfavorable terms with vendors, and all of those are part of the equation of what free cash flow is meant to be. And it's important to look at your business in this light, because it will allow you to proceed with the measures and projections that at a level that needs to be considered when managing the business.
Sorry, just to add on to that, David, a little bit, for example, David raised the point about terms with vendors. If you're having to pay your vendors quicker than you're collecting from your customers, that's going to put pressure, cash flow pressure on your business going forward month after month. So something definitely to pay attention to, and we'll talk a little bit more about that as we get into it.
Yeah, very good point. Now, the importance of cash flow, and sorry if I've started out with sort of the doom and gloom of not being able to manage cash flow, but there's a lot of good things that can come out of the creation of cash flow. First and foremost, it allows you to invest in your company, and if you are looking at growth, you need cash flow to invest in equipment, labor, new product lines, advertising, and cash flow is generally, you need cash flow to create new cash flow. So for any business that's in a growth cycle, it's very important to have a full understanding of your cash flows. Generating cash also mitigates the liquidity risk of adverse economic cycles, or even just economic cycles. There's a lot of businesses where February looks different than July in terms of activity levels, sales levels, and cost. A lot of times there's fixed costs that just continue straight line throughout the year, and the results of sales activity can have some volatility. So it's very important to keep your eye on the ball with regards to those cycles. It also lowers the cost of borrowing. It's interesting. The more liquidity you have, the more cash you have, the more profitable your company is, the cheaper it is to borrow money. The banks work on a risk and reward basis, and you will get rewarded for properly managing the cash flows of your business. And lastly, I think the largest benefit is at any exit strategy, any purchaser of the business is going to look at historical cash flows, and that's how they're going to value the business. So if you have a business that you're looking at in the short, near term, or even long term, that the exit strategy is, I'm building this to sell it, the more cash that you can generate in that business, the higher the valuation you'll get at the end of the day, which is obviously rewarding for all of the sweat equity that gets put into starting a business. The timing of cash flows. I've always taken a three-pronged approach to looking at the timing of cash flows. The first step is always going back to the strategic plan, and I'll define a strategic plan as a sort of a 3 to 5 year vision. It's generally at a higher level, but it will focus in on larger milestones that, you know, if there is future growth, we need to expend this money on, you know, new facilities, new equipment. We need to spend so much on increasing headcount or increasing investment in other areas. The strategic plan is always sort of that, you know, long-term guiding light as to where the business is expected to go. So you can have that vision when we're getting into the next stage, which is sort of that annual budget. And I would recommend to everyone on this call today that if you don't already, that an annual budget is very important for all businesses. Generally, I would suggest that this is done right down to the GL level. And the reason why I say that is within a budget, you have to have your owners. You have to have your P&L owners, and you have to have your balance sheet owners. And the best way to facilitate that is that, you know, actual to budget analysis that's done on a timely basis to show whether or not the business is proceeding as expected. And I'll go back to what I had previously said as well. When it comes to managing cash flows, it's just as important to have owners of the P&L as it is the balance sheet, because you could have your sales and costs in line, but if for some reason procurement has allowed inventory to build, well, you know, you've created a drain on cash. So the idea, the concept of managing cash flows comes from managing both your income statement and your balance sheet throughout the year. And finally, I think the third prong of the, you know, understanding the timing of cash flows comes from short-term cash flow projections. The need for these seems to, or the investment in time for this third prong will come relative to how tight you are with regards to cash flows. I've operated in businesses where, you know, when times are very good, you know, the investment of time into a short-term cash flow is generally very minimal, because if you have lots of cash in the bank and you've got lots of availability on credit lines, I do agree that it's something that still should be looked at. However, not as high priority if you're in the situation of where cash is very tight. And if you're ever have to answer the question, how are we going to pay the next cash flow? Well, this short-term projection should be have a lot of time and resources, and should be done, you know, looking at, you know, the coming weeks, months, and I've even seen it done, you know, on a daily basis when things have you know, gotten really, really tight. So these are all tools, and, you know, 3 different views of understanding the timing of cash flow. All of them are equally as important in their the necessity to prepare and analyze. But the third one, the short-term projection, if you find yourself noodling on that for various reasons, it's definitely a sign that cash flows can be strained, and you know, it's time to look at some of the strategies that we're going to discuss later on in this presentation. Jeff, do you have any?
Yeah, just to stop there for a second, David. Thank you. I want to address a couple of questions that were asked in the course of this. By P&L, we basically are referring to your profit and loss statement. So all of your revenues and then subtracting all of your expenses, whether they be direct or indirect or overhead, deriving down to your net income before taxes. So that's what we mean by P&L. It's a short form for profit and loss. There was also another question about GL, and yes, I can confirm that that means the general ledger. So in whatever system you're using, you'll have a general ledger set up. That's usually at the account level, which I agree with David that you should be doing your forecasting. And I can't stress enough the importance of forward forecasting. With regard to making it a dynamic, living document that you're constantly reviewing against, because if you can forward project, say for example, there's going to be a big order coming in, you might have, cash outlays against that order that you have to do to build inventory, to hire subcontractors, to do whatever that could put a strain on your cash flow, 1 month, 2 months, 2 quarters out. Good to know those things. And we'll talk a little bit about that forward view a little later in the presentation, but that's why I always recommend with my clients to do a fulsome forecast against your plan that generates your annual budgeting and then kind of flows into kind of shorter term projections on a weekly or a monthly basis as well. So I just wanted to clarify a couple of things, and we'll continue to move on unless there's other questions at this point.
Marissa just popped in and said, do you have any suggested templates for tracking cash flows to show the ideal level of granularity?
I'll address that question. I think that is an excellent question, and I'll focus on sort of the granular level. I think as much detail as you can get in, the better. So from company to company, industry to industry, they're all going to look different, but at the end of the day, however you're managing the business based on your general ledger accounts is generally the level that you want to start analyzing cash flows, because there will be different drivers for certain for certain items in the cash flow, and when we're looking at short-term cash flow, any volatility in sales levels or production levels will anticipate, sort of, grinding down or building up certain activities or resources, which will adjust future cash flow. So I don't think that there's any, template that, you could say, use this for everyone, but my suggestion would be, to get down to your account level and figure out what the driver is for that account, and be very purposeful in the level of detail that you put into these budgets.
Thanks, David.
Another question that has come up, another great question is, what's the #1 piece of advice for dealing with cash flow during rapid growth? Great question. One of the things that really, I'll make this a kind of a 2-part answer from my perspective, and David, please jump in. I would go back to my comment about forecasting. If you're anticipating rapid growth because your sales funnel is starting to look really robust in terms of conversion rates, you're anticipating a period of rapid growth, project that out to see and quantify to the best of your ability how much cash are you going to need, especially if you're going to need outside cash, because that's the kind of thing that your bankers can really digest and get their heads around. So be in active discussion with your bank. Banks are in the business to help you grow. And so if you've got a well-articulated forecast with a plan that shows, look, we have a current line of credit of, say, just to put a number out there, say $100,000, we're going to need another $100,000 to get us through this, growth period, and possibly more going on. With a well-articulated plan, the bank is would be probably more than happy to say, hey, you've got it mapped out. It looks like you know exactly what you're doing. You've got, you know, your hands around it. You have management has a good understanding of what's coming in the future. That gives us confidence that you're planning. You know, we'll definitely want to sit down and talk about expanding that line of credit. So be active with your projections, be active in dialogue with your bankers as well, because you know they're there to lend money to you, to open lines of credit to help you grow. They're in the business of, their business is to make money off your growth. And so they're more than happy to expand those lines of credit if they're confident that you've got a plan going forward.
Yeah, no, that's an excellent answer, Jeff, and would have been the same answer that I would have provided as well. You know, having this information prepared for your bank will answer a lot of those initial questions. It'll make the dialogue go a lot smoother, and the bank is there. You know, they're going to be your friend through this if you can show that, you know, you've got a solid plan that's built on, you know, verifiable assumptions. Okay. Sorry. Which brings us to the topic of the cash conversion cycle, which I think is an excellent exercise for all businesses, all operations to go through. Essentially, what it's doing is it's assessing the cash conversion in the number of days. So when you think about how your business works, in a typical business, that's, you know, let's use the example of selling inventory, but, you know, first you have to acquire the inventory. So, you know, you're going to have a certain number of days that your inventory is going to be on a shelf. And then and after sale, if you've provided your customers with terms, then there's going to be a number of days before you have that receivable turned back into cash. And all the while you have to pay attention to that, you know, your vendors, you know, have to get paid within terms as well. So this can be an excellent analytical tool in sort of, you know, measuring the total amount of the days for this cash conversion cycle. And, you know, later on in the presentation, we're going to be talking about some tools and strategies around, you know, reducing the number of days when it comes to managing the balance sheet. But this is a very good exercise for all businesses to go through, because, you know, obviously you want to, you know, you want to see a reduction in days that inventory is on a shelf where receivables can be collected, but you want to see if you can also extend the number of days it takes to pay vendors, and it can have a, you know, significant impact on the, you know, cash generation within a business. Jeff, do you have anything you want to add on this topic?
Yeah, just on the vendor side, I think that there is always a very fine balancing act. You know, as a customer for your vendors, you always want to try to pay, you know, within terms. In some cases, you may be forced in a situation where you're stretching out your payables a little bit, but to the extent possible, you want to be regarded as a customer that pays on time to the best of your ability, because that will allow you to secure better terms. It will allow you to secure larger volume purchases when you need to do that. You know, you're just viewed in a better light when you can try to do that. You know, there will be times where things get a little bit tough. You may have a customer that runs into difficulty with a big receivable that you have to stretch things out. But my advice to all of my clients that are sitting in a good cash flow position is pay your vendors on time, because that reflects well on your company and allows you to secure more competitive terms, because it's about your brand as a business as well.
Very good point. Which brings us to the next topic. Business plans are prepared with certain expectations in mind. The reality is not all factors land as expected. And I think this is a very important concept because it shows the amount of detail that should go into a business plan, but you really need to understand, how reasonable or how factual some of the large assumptions are when creating a business plan. Now, back in 2018, there was a lot of 2019 business plans that were prepared, and I would guess that none of them predicted lockdowns as a result of global pandemics. There's certain things that happen that are sort of outside of what's expected to be incorporated into a business plan. However, if you have aggressive growth plans, you're going to grow sales by 20%. It's really understanding what are all the drivers behind that, because chances are if you're predicting significant growth, there's probably also plans to increase production or increase procurement or increase headcount, and all of those are investments into the business. However, if these assumptions for growth don't come to fruition, there's a risk that you've overproduced or overinvested into your business at a particular point in time. So, I guess what this boils down to is really understanding the drivers of your business activity, and putting a reality test to all of them to make sure that if there is any significant movements in investment, that they are backed with some support.
Another couple of questions that we've got, really good ones again.
Sure.
First one is, how can I effectively manage multiple projects with multiple accounts and partners? And it's a struggle to kind of keep everything organized. That's a great question. And I actually have a client that has a similar situation with regard to what's been described as in these circumstances. And what they do is that we've got multiple bank accounts, and we know what the flows in and out of those accounts are. And we break them into two general buckets. One is a bucket of fixed recurring outflows. So we've got things like rent, payroll, remittances to government authorities, things like insurance, that regardless of the level of business that you're engaged in, that these are expenditures that are going to be coming and hitting the accounts every week, and or recurring throughout the month. And we typically break those into weeks during the month so that we can see what's coming in the month, and we monitor that. And then we have another couple of segments that look at, okay, well, what receivables are due on different projects during this month. We know when we build, we know what the terms are, we know what the due dates are on these receivables, so we can map those as well. And the same thing with payables, especially if they're tied into those specific projects. That you've got subcontractors, you've got vendors that have provided services. Again, you'll know the due dates from your systems as to when those payments are due. And so you've got a series of fixed versus variable cash flows that are coming out at different times, and you can organize those by account as well. And with any of these questions, through the Sandbox, more than happy to have conversations offline as well with individuals. If they have questions for David or I, we're more than happy to take things offline as well. If you want to have a quick chat about it, we're here to help if we can. There's a second question. What impacts do inflation and potential interest rate hikes have on your business projections and cash flow? Again, another great question. When I'm forecasting and working with my clients on forecasting, we'll build in assumptions around inflation on the cost of labor, inflation on the cost of materials. Right now, we've seen significant inflation on the cost of certain materials because supply chains have been basically put under stress because of the limitations and social distancing associated with the pandemic. Business flows have been interrupted. So we're seeing significant increases in the cost of certain metals, wood, certain commodities, and that's really creating a challenging situation for projecting, how is that going to impact on our pricing? How is it going to impact on our costs going forward? And then also interest rates. We've been living in a time of, long time of low inflation where interest rates have been relatively low. But if we are ever entering into a situation where we see inflation, which we may, who knows, coming out of this pandemic, you'll want to test different assumptions around the cost of borrowing money. Particularly if you've got floating interest, facilities with your banks. So those are all things that we put into our assumptions so we can stress test our forecasts. So, okay, let's see what it looks like if inflation is not, say, 2% per year, but what if it goes to 5? What if it goes to 10? What if we have a period of really high inflation? And with a well-built forecast, you can see what the impact on your business is. And yes, absolutely, with regard to sharing contact information, more than happy to do that. Mackenzie and the Sandbox have our contact information, and we're more than happy to hear from folks. There's another question that's come up, and maybe I'll flip this to you, David. Best choice between cash and accrual method accounting?
Oh, that is an excellent question. Now they both have their pros and cons, but as a CPA, I'm always, I'll answer that question is to get a true balance sheet. You need to be performing the accrual method of accounting. So I would suggest that your books and records should be done on that accrual basis. However, when times are difficult, or go back to a previous question, there's a plan for investing in multiple projects. That's the time where I think outside of the formal business records, you need to have a cash flow analysis that's prepared on a cash basis. I think if entering a new business plan, or faced with going back to the slide that we're looking at right now, if the expectations that were predicted don't come to fruition, and you find yourself needing to do some tight turns with the direction of the business, having your side analysis being your cash flow analysis, that should be done on a cash basis to truly know that whether it's day by day, week by week, or month by month, what the impact of these potential cash constraints can have on the business itself. So apologies, it's a long-winded answer where I sort of talked about both sides of the question, but I think that there are places for it. Again, to reiterate, I think your books and records should be done on an accrual basis so that yourself, lenders can have an accurate view of the balance sheet. But when it comes to analyzing cash flows, that's usually done in a separate analysis. Jeff, are there any further questions at this point?
No, I think we can proceed ahead and look forward to some more questions.
Excellent. So anybody who has a lending agreement, for example, with a bank, I'm sure that you're aware of the financial covenants that have to be maintained and reported on either on a monthly, quarterly, or annual basis. These covenants are very important when you're doing your cash flow planning, because essentially, they form part of your relationship with your lender. And when preparing a cash flow analysis for the year, it's always recommended that you forecast out all of your financial covenants based on the reporting dates, and really understand how much cushion you have with those financial covenants. If there's ever any indication that you're getting when you look at your future cash flows, that there's a future risk of breach of financial covenants, it's very important to have conversations with your lender as soon as possible. And this all boils down to relationship management. I've worked in several industries where due to economic cycles, cash has been tight, and there's been future risk around financial covenants. And it goes a long way to actually sit down with the bank and say, this is what I'm seeing 2 or 3 quarters down the road. There is a risk that, that we need some extra cushion, and possibly even apply at that time to say, can we have an amendment to the lending agreement, which gives us a little bit more wiggle room for the next, 3, 6, 9 months, until we, flush through the current economic cycle that we're in. And that strategy is far more impactful than the reality of what happens if you breach a covenant and then talk to the bank. Because when you're talking to the bank on a post-mortem basis, there's, they don't have as much room to help at that point in time. And I think the best way to describe a banking relationship is you have a lending manager, a banking manager that you're probably going to talk to on a frequent basis. However, all the decisions are being made back in the credit department. So your relationship manager works on your lending agreement with the credit department and is fighting for your best interests. However, if you're leaving them with no time for the risk of a breach of a financial covenant, they've got less tools in their toolbox in terms of going to that credit department and saying, okay, we've got to help these guys out. So, again, I can't stress enough the importance of, really being as transparent as possible with your bank manager with regards to any future projections that show some risk. Jeff, is there anything you want to add on this topic?
Maybe just a very, very quick story that will illustrate the point. I think it's a great one to make is I was involved as a CFO for a company where we debt financed the consolidation of ownership and bought out a 50% shareholder who controlled the operations of the business at the time. We closed that transaction with a set of projections that the bank took to credit and approved the financing. We were a few weeks into post-closing and detected a surprise that the vendor of the other 50% of the business failed to disclose to us. And it threw all of our projections off when we reforecasted. We immediately went to the bank and said, as a result of this, by the end of the second quarter of our projection, we are going to be off this one particular covenant. Because we went early, we explained the situation. We provided the bank with a plan for how we were going to address it. They went to credit and immediately came back and said, we'll provide a technical waiver of that covenant if that happens to come to pass, which it did. But we had the technical waiver in place, which allowed us to carry on. And as a result of that early warning that we gave to the bank, we had a very, very good relationship with them throughout the period that I was there. And so just to illustrate the point that, if you're anticipating some challenges, talk to your bankers, give them the opportunity to be able to help you, to have good dialogue about it, because what they'll be interested in is, that kind of disclosure. Banks do not like surprises. And the more you can get out in front of it, the better, definitely.
Yeah, no, I think, Jeff, you summed it up with the banks don't like surprises. I think if everyone can sort of remember that statement, it will go a long way in the future of your business, whether it be growth or dealing with economic cycles. But that's an excellent piece of advice.
Yeah, we've got another question, another very good one is who's responsible for doing cash flow projection? How often is it usually done? Is it redone every month? And how far is it done in the future? 1 year, 2 years, 5 years or more? All great questions. I'll try to maybe provide some of my answers. very quickly on each one of those. Typically, it'll be somebody on your finance team that will be doing the cash flow projection. It could be an analyst, could be a controller, could be a CFO. We'll typically own that, but always working in tandem with management, because that active dialogue with the management team as to, what does our sales funnel look like? What is the timing of those sales projections? What kind of pricing are we looking at with regard to our vendors? And what are the terms that we're going to be looking at? How we negotiated payments of our rents, insurance, all of those things. Is there any bubbles coming up with regard to having to make some major outlays? So there has to be a very active dialogue within your organization, but the owner of that will typically be somebody on your finance team. How often is it done? What I typically like to do is I like to have a forecast with a budget, and then to do that is the budget, and that's typically set, and then we measure performance against that budget, so we can have as a team active dialogue as to what's going right, where are we off in terms of negative variance, why is that, and what are we going to do about it. We will reforecast so that we know where we're going to finish. Typically, we'll do it monthly, just so that we can keep it fresh as to, okay, this is how we thought we were going to complete the year. This is now what it's starting to look like. And that can be more or less, like it can be negative or positive. And I think positive variances are something to discuss as well, because there's something to be learned by all of it. How far into the future? I typically like to do financial projections about 3 years out. Depending on the business, of course, I find anything past 3 years, the projections start to lose their value because it's just too far out. And I think the last year and a half has been a very good example of that, because if you had been trying to do a 5-year projection in 2000 and at the beginning of 2020, you would have found that your projections were quite a bit different, and the further out that you went, the more murky it gets. So I typically like to do 3 years of projections on a monthly basis. David, would you add anything to that?
No, I think that's an excellent answer. I think, just touching on responsibility, I think, it's generally that person in finance that is pulling this all together. But I'll reiterate that anytime you're looking at sort of the budget to variance results, the people in operations or people in administration, whoever is the owner of that profit and loss segment of the business, has to be able to speak to these variances. Are they one-offs? Is it something that's going to
an urgent message to anyone with type 2 diabetes or pre-diabetes? This discovery could save your life.
Sorry, there was an interruption there. I was actually paying attention to it. But there's going to be owners of certain segments of the business, and I think finance and operations and administration all have to work closely together in understanding those budget to actual results, because it's going to be through a team approach that you either have to adjust or understand or assess other risks that need to be mitigated along the way. But yeah, it's an excellent question. I'm glad we had the time to address that. Okay. Are there any other questions at this point in time?
Not at this point, David. Thank you.
Okay. So when we look at the management of the balance sheet, and specifically, this discussion will be around sort of the working capital. And, I'll define working capital as, your current assets and your current liabilities, being your inventories, your accounts receivable, and your accounts payable. Because there are tools that you can, work with either your lending institutions with regards to managing items that are on your balance sheet. And for example, you can finance your accounts receivable and inventories through bank operating lines. And if you don't have an operating line with the bank, generally you know, the way this would work is they may say, well, we're going to give you an operating line of $500,000. And at each month end, you need to submit, you know, your receivables and inventory. They might give you, they'll have a calculation of generally 50% of inventory and 75% of accounts receivable. And then you can borrow up to that limit within your operating line. So for businesses that, you know, have to hold a lot of inventory, there's a longer cycle to the inventory or a longer cycle to the accounts receivable. There's a way to sort of, you know, front the cash into the business to help, you know, neutralize a portion of that investment that you have on your balance sheet. There's also another strategy, which is factoring accounts receivable, where essentially what that means is if someone owes you $100,000, you can sell that accounts receivable. You know, the seller may give you $95,000, and then it's up to them to collect from the customer. And the benefit they get out of it is, you know, they collect the full 100, and they've made the $5,000 in the interim. So what it does is it speeds up your cash collection, but at the cost of, you know, reducing the value of the receivable. So it will be eating into your margins. However, in times where, you know, cash is king, it is a way to you know, to help to further another tool to bring cash into the door a little bit earlier. Another tool is offering your customers a payment discount, which is somewhat, you know, you get the same result as the factoring, but offering your customers a discount if they pay within 10 days as opposed to, you know, 30 or 60 days. You know, you're giving your customer a benefit. If they have the luxury of having cash on their balance sheet and they'd like to take the discount, you get the benefit of the cash coming in early. And then one other strategy that I wanted to mention today was working with your vendors and with payment terms with vendors. You know, a lot of times, you know, the strategy of paying in net 30 days, moving it to net 45 or net 60 allows you to, you know, stretch out, you know, your cash outflows. But, you know, as Jeff mentioned earlier in this presentation, it's very important to work closely with your vendors, with your vendors, and paying your vendors on time, every time will build you that credibility. If you're the one that they're not calling, then, you know, chances are when you do need to call to stretch out payments, you will be allowed to receive that extra little bit of rope in your terms. But that being said, it's, you know, a very important relationship to manage. Never treat your vendors like a lender. Don't stretch them out because you need the cash, because you're just affecting their cash flows and creating animosity within that relationship. Jeff, any other ideas or comments around working capital strategies?
No, but a couple of questions. Just David, would you look at factoring as more of a last resort? Where would you kind of think about that or see that in the array of financing options?
Yeah, I would. And the reason why I say I would is because it's generally the most expensive out of all of these strategies. You know, you're passing off, you know, not just the risk of collection to the person who's factoring, but also, you know, the time value of money as well. And I think out of all of these tools, that's the one that's going to, you know, hit your margins the most. So generally speaking, unless you can find a very good factoring arrangement, that would be the one that I would reserve for if and when times are tough. Having that relationship with a factoring agent in advance, so you can quickly dial it in, I think is a good strategy as well. But it would be one that I would leave as a last resort.
Okay, great. And then for a company that's in the planning stage, forecasting is a bit of a challenge with regard to any tips on that. So this would be, maybe it's a startup situation. My suggestion is an advice, and I've been in this situation. I've been involved in 3 startups. Is scenario and sensitivity planning becomes very important. If you're a startup without a lot of history, or you're in that planning stage, I would look at it and say, okay, let's forecast out a kind of a high, low, and base scenario so that you know what the risks are. Like, what if in the low case scenario, things that we're hoping will happen or that we anticipate will happen will not happen, or they'll happen in an adverse way to what we're hoping and expecting. And then kind of a high scenario is, okay, well, what if everything goes exactly according to plan? What does it look like? And then somewhere in between is probably, where things are likely to land, and more of a base case. So when I'm projecting out, I'm working with people to project out, and it's a planning situation. It's the front end of the life cycle of a business without a lot of history. That scenario planning and sensitivity analysis becomes even more important. David, would you add anything to that?
Yeah, I agree. I think that it's crucial if you're going to put in, your time, sweat equity to start a business. As the business grows, whether or not you're going to be talking to, future investors or future lenders, you will need a business plan, a detailed business plan that's going to forecast, what this activity is going to look like. But even that aside, if it's something that you're going to operate in the absence of any other investment or outside lending, you're going to need to know, as Jeff stated, sort of the volatility of what the cash flows are going to look like, because there's a lot of small startup businesses that your risk of failure increases significantly in the absence of a plan. So I'll go back to saying that if you fail to plan, you plan to fail, because it is critical to understanding the business and the cycles of the business and what it takes to ramp a business up. Holding inventory, holding receivables, that is, you got to understand, the impact that it's going to have on, ability to pay payroll or pay rent. So Jeff, an excellent question, but, I'll reiterate with what you said. It's, project, plan, forecast. That's where the upfront time needs to be spent. Okay. And, lastly, we talked about working capital strategies, but there's also long-term strategies. And, having too much debt on your balance sheet, reduces your future flexibility. However, there's also the concept that you need to have the appropriate amount of leverage on your balance sheet. And when I say leverage, what that means is, the proper amount of debt. So I think it's very important for all business owners, for all startups in the planning processes, to really know, when you look at the balance sheet, how much equity and how much debt is required and appropriate for the business. Another tool is to ensure that all of your long-term assets have appropriate long-term financing. And the perfect example is, if you have a if you have a mortgage, it's going to be, you know, at a much longer term because it's amortizing over the life of the asset. Where if you had equipment, it's generally at a much shorter term because equipment needs, you know, either maintenance, capital expenditures, or replacement, you know, in a shorter lifespan. So it's you know, one of the tools to balance your balance sheet is to ensure that you have, you know, the proper long-term debt against those long-term assets. And one other I guess insight from my experience would be that if you're ever dealing with, you know, equipment financing or long-term financing, you know, a lot of time there's options that the vendor can provide, you know, that may be favorable terms over what the lending institutions can provide you. So I think it's, you know, really explore all of the options when it comes to financing your long-term assets, because there are a lot of lenders that can you know, fight for a piece of your business as well, that can benefit you with either interest rates or term or flexibility. So all things to consider with regards to managing your long-term assets against your long-term debt. And I guess that leaves us now, and I think our timing is excellent. But if there's any other questions with regards to any part of this presentation, we would be happy to assist.
We do have a question about financial ratios and what are the key ones to look at. I think another great question. There are many different types of ratios with regard to the measuring the health of a business that can relate to profitability, you know, your gross margins, your net profit margins. We talked about a couple of cash ones with regard to, for example, the cash cycle. You know, there's many different ratios that that you can take a look at. And, you know, given the constraints on our time, I'd be happy to provide a list of those to the Sandbox and for sharing with the group. Mackenzie, if that would be appropriate, I'd be more than happy to do that and share some of those.
Definitely, that would be amazing. Cool. Well, if there's no other questions, I will wrap it up from here to be respectful of everybody's time on the line today. Thank you so much to David and Jeff from the CFO Centre. Your perspective was so extremely insightful. I loved all of the examples that you were able to provide us and all of the questions from the attendees. Thank you so much. It was really interactive and awesome. Massive thank you to our partner CFO Centre again for delivering today's sessions, and registrants who couldn't attend this session will be provided a link to the recording afterwards. I know somebody was asking, we'll be providing the presentation and the recording as well as the gentleman's contact information as well. So thank you so much for being here. Our experts in residence sessions vary from month to month, like I said, across a bunch of different topics. Be sure to go check out sandboxcentre.com on our events page to get in the know. We actually have another EIR coming up next month, November 18th, with NetGain and Central Ontario Broadcasting on seasonal marketing approaches to win the holidays. So make sure you go check it out. We appreciate everyone's time and for joining us today, and just wish you a great rest of the week ahead. Enjoy the sunshine today, and we'll see you next time around. Thanks so much, everybody.